As we promised you earlier today, in just a second, we're going to have Nathan Long with Quest Trust up here. Then I'm going to have the technology panel that we talked about. And then for those of you that were here last year and saw the first edition of the Note Talks, which is our TED Talks, we're going to have 3 of those before we take our welcome reception. And then tomorrow morning, we're going to have a few more of those. So those are really impactful, and we're looking forward to seeing those. But we're going to start off with Nathan Long and Eddie Speed. If you guys can join me up here. And Nathan and Eddie are going to talk about, now check this out, real solutions to real life problems, buying and selling notes in your self-directed IRA. So, with no further ado, Nathan.
What is the button you push? Just the big green one?
Just the big green one. Oh, you can push them all, but no telling what will happen.
No, this green one.
The big one. That'll just give you a laser beam there.
Oh, if you punch that one there, it's kind of...
Woo! Some stuff's going to happen if I push that button. How you guys doing today? Like I said, the ice cream must have been pretty good. I asked Eddie to stay on stage for me because I really think that there's some things I wanted to talk about that I think that you could help with. And I told you that I wasn't going to just give you the basics, but I got to give a little bit of basic information just to cover, legal problems, but also there might be 3 or 4 people in the room that's never had it. If you never had it or never heard it or anything, hang on with me for a second while I go through this real quick. All right, real problems, real solutions, all the things. Disclaimer, at Quest, we don't sell anything. How do we make our money at Quest? We charge transactions fee when you guys do good deals. You understand that, right? You also understand how that we charge transaction fees when you guys do bad deals. Everyone gets that? You can figure it out yourself. Matter of fact, a lot of people don't understand it, but it's true with any self-directed custodian. We're legally obligated to process whatever investments you tell us properly to do. So make sure that you're taking time. I see investments that I wouldn't do all the time, that get processed. Sometimes I'm right. They shouldn't have done them. Sometimes I'm wrong, but make sure you're taking the time to do your own due diligence. A self-directed IRA isn't really a type of IRA at all. This is the part where I'm going really fast, by the way, guys, just to get through it. A self-directed IRA isn't really a type of IRA at all, right? It's just a marketing term. The only difference between Quest and someone else like Charles Schwab or something like that is we hold publicly traded assets, and what they do is they hold publicly traded assets, we hold private assets. One of the big things, or one of the mistakes people make having a self-directed account often is leaving a lot of cash sit with their self-directed custodian. You're much better leaving that money sit over at Charles Schwab or Fidelity, and then as you transactionally need it, you move it in. That being said, some of the other custodians will move that money very quickly, and other ones will move it very slowly, and you have to have an idea what that timeline is. I mentioned Charles Schwab and Fidelity. I have a back office relationship with both of those. Sometimes I can get money in 2 or 3 days. Most of the time we're not going to fund a transaction that fast, and so it doesn't just need to sit in your account and get in others. But there are some that take 5, 6 weeks. Wouldn't give any names or anything. It's Wells Fargo, but there are some out there. So just know how long it takes. Things. There's all different reasons to have a self-directed IRA. One of them is diversification. Don't you know you're supposed to have your portfolio diversified? I'm not diversified at all. I have notes on top of notes on top of notes, and that's the truth. I know it's part of the presentation, but I don't actually tune to that myself. I figure if it's something you do really well, just keep doing it, right? I got a couple of private placements and a couple of rental properties left, but not very much. My brother takes care of it. But there's, if you're going to spend time, taking time to do a weekend like this, you're learning about how to build wealth. You also got to spend some time learning about tax problems. And some of that Quest can help you with. We'll deal with the IRA part of it, but just in general, you should spend some time. But there's something that about having a self-directed account a lot of people don't think about is that there's some social benefits to it. Yeah. In other words, if you just buy a mutual fund, you're just buying whatever companies they offer, you're throwing a blanket across it, you know what I mean? And eventually you'll have some companies that won't be aligned with your ethical or your political intention. If I buy a note, I know what I'm doing. You know what I mean? I could drive by it and see it and touch the house or talk to the people or do whatever I want to do. I'm investing in typically my own home where I live, work, and play. Anymore, I have notes all over the place, but things. But it also allows you to invest in things that you know and understand. There are all types of accounts that can be self-directed. A lot of people think that only like a traditional or a Roth IRA is the only type of account to be self-directed, when the reality of it is 84% of the investments we funded last year were tax deferred or from the traditional IRA. Why? Because that's where most people's money is, from an old 401k or 403b, and most people don't do that Roth conversion. That is not true with the people in this room. You guys hit me every day with conversations about Roth conversions, and I love that. That's one of the reasons why I love coming out here. I get to have things.
But Nathan, people call their accountant, and 99% of the time when they talk to their accountant says you make too much income, you can't have a Roth.
Right. There's a lot of people that have misunderstandings about Roth IRAs and having it. But the basics is, if you're going to knock it over the fence, like you know for a fact you're going to knock it over a fence, it makes a lot more sense to pay the tax now than pay the later. Because tax ain't going away.
What's the saying?
Huh?
What's the old saying?
Pay on the acorn, not the money tree? Is that what you're talking about?
Yeah, I've heard it said a bunch of different ways. You pay tax on the seed, not the harvest.
Right.
Or the acorn and not the tree.
Right.
So the idea is, if you're doing a highly leveraged deal, it makes sense to move part of that money into a Roth and then, pay the tax on that, and then that money can do a partial or whatever.
And I get a lot of people say, oh, I shouldn't do that because I'm 75 years old. I'm like, really? Are you dying tomorrow? You know what I mean? It doesn't matter. It's also very much used, or we use it all the time, especially in the note field, with preserving wealth for generations. Yeah. Using a Roth IRA to pass wealth on tax-free in unconventional type of ways. Sometimes we will tie up notes. Why? Because sometimes the person inheriting it might not be very good at managing money, so we'll put them in longer term type of things that are more difficult to sell out that pay out and things like that. Okay, enough about that. But traditional Roth IRAs, we also do SEP IRAs, simple IRAs, and a lot of people use these solo 401ks. Right here in Dallas, if you guys are in that area, we have a solo 401k expert. At Quest, I think that if you have a solo 401k, you should always be doing a tune-up on it every once in a while. And even if you're with another company, you can call Quest and ask some questions about your 401k and make sure that you're doing it right. It's something that they do there. They do a lot of consultations for free. But one of my favorite things, and I talk a lot about this upcoming month at Quest, is investing with a health savings account. Sometimes with the Coverdell Education account too, but a health savings account's an amazing account to do it with. But one of my favorite things to do with these types of accounts is actually partner them all together. Often these accounts are disqualified, but most of the time if I'm buying a note or going in the note field with my IRAs, it might be my IRA or my wife's IRA, my son's IRA, my mother's IRA, and we partner all of those little IRAs and we do a loan. Why does that make sense? Well, think about it for a second. If from my family, if I partner all these things together, this is kind of how I got Derek involved in the note business.
Exactly.
We would, do investments together. It's teaching my children about investing with me. I started when he was 18 with a little Roth IRA with only $5,000. I would just partner it with my account so he could see how it works. Does that make sense? It also allows you to pick up these little accounts that are laying around. You have a little bit in a Coverdell or a health savings account or whatever, and you can partner them together and bring them together to do one investment. Now, as the money comes back, it will split up according to what they're doing, but that's really cool. That's from my point of view, the borrower. How about some of you people that are doing this? You're borrowing from someone like me, an investor, and then you're running the split. Who's doing that here, right? Things. If you're doing that, you're seeking money. You're seeking money to buy loans to invest with. You're looking for people like me that would invest with you, correct? Now, if you just talk to me and I loan you some money, me and you have a relationship. But if you talk to them and get their IRA involved and bring in a Quest IRA person and we start using all that family's money, then the whole family starts to have a discussion about investing, and you bring the whole family into it.
It's what happened to us. I mean, Martha started taking the kids' money when Hudson and Wood were in high school, and she started doing partials with their IRA money, and by the time they were both seniors in high school, they could explain to their economics class what a partial was and what a self-directed Roth was.
It took Derek a little longer, I'm going to point that out.
No, and I mean, really, I tell people, I usually think these millennials are not going to be interested in any of this stuff, but I'm telling you, when Martha started taking their money and investing it, they became the most interested in the note business ever. They grew up with me on the phone talking to them.
Well, that's one of the things. You can't tell the kids anything. You can't. You have to show them.
Yeah.
You give them some money and you actually show it grow into some more money, and then all of a sudden, for Derek it was about 26. You know why I think it's about 26? Because that's when you really have to actually start working hard. You start to realize that it's not really fun trading time for money all the time. So, thanks. There are some restrictions I want to talk about real fast before I get to the problems and solutions. You got to understand these because they're deal stoppers, right? They're people restrictions, transaction restrictions, and investment restrictions. The main one is people restrictions. There are people who are disqualified from the IRA. They can't buy, sell, trade, loan, or extend services to or from the IRA. Who are those people? Well, it's you, right? You are disqualified from your own IRA. You separate out that money and invest it separately. You use your IRA for your future. You use other people's IRAs to make money now. Everyone got that? In addition to you, there's a group of people who are equally disqualified. I'll send you the slides if you guys want to, right? But those people, forget the chart. It's just you, your spouse, your lineal ascendants and descendants, their spouses and companies those people own, control, manage, or highly compensated by. Boom, we're done.
Y'all get that?
Y'all get it?
All right, everybody get up. We're going to do it together now.
It's just not family members, but it's you and your kids. Everyone got it, goes up and down the family tree.
Or employees.
No, not necessarily employees.
All right, let's talk about that.
All right.
So, well, you know, I've got an executive team.
Uh-huh.
Can I do business with them?
Sure.
Okay, you think I can?
Depends on what they're doing. Do they fall under a highly compensated person? So this goes back to one of the things that you have. And highly compensated doesn't necessarily mean how much money you're paying them. It's a legal term of art. Matter of fact, in Texas, high compensation can be love and affection, Eddie.
Martha thinks I'm highly compensated at this point.
So it could be yes or no. There's some structure in there, and if you're going to do that, what you should do is do what Martha does: pick up the phone, call an IRA specialist, and make an individual talk about that so that you understand it. So those things. There's prohibited transactions. I've already said it. It's the things that people can't do. They can't buy, sell, trade, or extend a service to the IRA. That includes your credit, by the way. You can't extend your credit to the IRA. There are some investment restrictions as well, but it doesn't really matter because they're kind of silly. I'm looking at the wrong slide. It's like life insurance contracts and collectibles. Collectibles are specifically defined as works of art, gems of metal, or alcoholic beverage collections. Like, again, booze. You can't buy booze with your IRA. That's right.
You can't buy wine that would be an investment or something. I don't know. They thought of that.
Anyway, if you have questions, ask an IRA specialist. We'll help. Okay. At Quest, we kind of break up our different departments because we got real estate. This is the direct purchase of real estate in IRA. We have what we call our private entities. This is LLCs and limited partnerships and joint ventures. And then we break up direct purchase of notes. Most of the time, when purchase notes, it's direct purchase, but not always. We use LLCs and trust and different things, and that's one of the things that we're going to talk about. Does this stuff work? Yes. Here's my superstar slide. This is one of my notes. Bought it for $40,000. The property was not worth anywhere near what the note was on it. That's why it was being repossessed. At 68, I ended up renting it back to the people who were already in the house. They kept it for a couple of years, were able to fix their credit, and then they bought it back from me. It was absolutely a great deal. It was one of the best things about that particular deal was the people had lived in the house for 15 years. And they were losing the house because they had put too much money onto it, and he had lost his job to an injury, but his life was getting back together. And I was able to actually help these people stay in their house where they raise their children and all that other stuff.
Emotional equity.
Emotional equity, emotional equity. You talk about that all the time. Here was a partial note. Why don't you help with this? Was a while ago, Martha, bet you might remember this. Purchased a note for $19,000. Still getting payments on it. Do you think that I'm likely not to get payments on this? Look at the security on that. But for me, every time I'm looking at buying a note, what am I really paying attention to every single time? For me, it's just the yield. I want the yield. Now, if I get paid off quick early and I get a little pop in there, great. But as long as I can get a consistent yield in my IRAs, anything above 10%, I'm usually in good shape. And I think that mimics a large number of my clients.
Yep.
Thing. Here's another one. This is a little partial. This one did pop early, paid off quick, and end up with a 74% turn. And here's another one that got about 219. All right, let's get on with the issues what I talked about. How should you take title to a note inside an IRA? Right? Should I directly own it by the IRA, or should I use a LLC or a trust or something like that? What do you guys think? Exactly. It really depends. I think if anyone gives you like the blanket answer, that's the wrong answer for anything. It depends on what you're doing. Let's talk about the reasons why. Let's start with about the issues of an LLC or a trust. The issues goes back to what I was talking about with the disqualified persons. It used to be you just form a checkbook control IRA. Everyone did it. And Quincy and Nathan's were real nerds for talking about the fact that we thought that might be prohibited. Why? Because the managing member is a disqualified person. That would typically be you.
And half of the people in the industry allowed it.
Half the people in the industry allowed
Half of the IRA administration companies says, "Oh, that's no problem. You can do it." I bet you I've asked Nathan or Quincy more of this than any other single question I've ever asked, because there was a disagreement amongst the industry over this.
Sure.
So this is like, there's going to be somebody in here this affects. This is something that we should talk about a second. So you guys have never liked this.
I've never liked it. I think that you've taken a very myopic view whenever you use the Swanson case to justify that you can be the managing member of your own LLC. Now, there is an exception to that. In the 401k, that would be okay. That's the only account that's solo 401k. So I want to throw that out as an exception.
All right, so I want to talk about practical and just, so Martha and I's card game, our bet is this IRA game, okay? So I'm telling, it's our card game. So there's no possible way that I would do something that would risk getting an account busted. Right? I mean, that to me would be, I mean, if you had $200 in an account and it got busted, okay, well, you $200, right? But if you got your whole future bet on this, you couldn't take that risk in my mind.
I wouldn't, and the risk has gotten greater. In the past, about 5 years ago, the Board of Labor sent out a letter saying, "Hey, we don't like these single manager things. No big deal." Board of Labor oversees or writes the directives for the IRS. Last year, they required self-directed IRAs to do something they never required before. We always have to tell them what's in the account every year, how much money it is. Now they've added an additional thing. They want to know how much money in the account and if it's a single manager LLC. Why do you think they want that information? All right, prohibited transactions allow them to collect a lot of money on fines, and so they're looking for this. Specifically, I've drilled into this with everything. They're not looking for the single manager LLCs. What are they looking for? Single manager LLCs with disqualified persons. Everyone follow that? It's the fact that you're the managing member of that entity that is the problem. All you have to do to fix the problem is to remove that. Instead of you be the managing member, have someone else, a trusted friend, somebody that's not on that list, not you, your spouse, your lineal descendants, your spouses, or managers. Everyone got it? Not one of those people. Somebody else, and just put them in there. And that's true whether it's a trust or an LLC. Now, why would you have a trust or an LLC? Let's take all the things out. Right. You've got to ask that question. Normally, we use LLCs for asset protection. We're in the note field, a little bit less need for asset protection, but also IRAs are already kind of protected there. So we kind of take that one off, right? It's very hard to penetrate an IRA for the purposes of, or have it spread to other IRAs and everything else. It's already kind of sealed in there. Everyone got that? So why do you need it? Because you could get feed to death.
Yeah. I was going to say, so Martha's story is this, and she learned this from Quincy. Quincy's taught her how to do this, right?
Right.
The guy that owns the company. And her and Martha and Nathan and that three of them have had this conversation a lot. And we've tried to teach this. Martha's tried to help you guys teach this,
right.
What she's learned. But for her, she's the IRA owns a trust. So that $200,000 hypothetically is cut from the IRA to the trust, and the trust is in a checking account that Martha's trustee controls, right? Nathan can't fund that $200,000. He's already funded it. Quest has already funded the money. Now it's in a trust, and our trustee can do it, and it's definitely not a prohibited party. And so now, when Martha gets ready to fund a deal, Martha can rapid speed do it because she's not having to go through the funding process, and it doesn't matter whether you guys are great at it or not.
Two reasons that you need it. I'm doing enough deals that I'm paying too much in IRA fees, good for me, bad for you, right? Or that I need that quick ease of use. For a lot of people, though, a lot of people are buying 1, 2, 3 maximum in their IRAs. Notes, they're longer term, they're not Martha, they're not movers and shakers, they're not buying and selling, they're not selling options, they're just looking for mailbox money. They ran into one of you guys, you know what I mean? You put them in a long-term deal, they got $200,000. That person doesn't need a trust or an LLC. Do you see what I'm saying? If I'm only got 1 or 2 deals, there's no reason to have a trust or an LLC in there.
All right, so let's talk about this, because I hear this a lot, right? You and I have been around some significant belt and suspender types.
Right.
Right? I mean, if they're going to have a double safe system.
Right.
Right? And what they were worried about is asset protection. Right? And they say, I don't want my IRA to own an asset that's in the courthouse because somebody could then go after my IRA. Right? So they think that's the reason that you do a trust or an LLC is asset protection.
Right.
So let's talk about that.
Well, an IRA is already an entity all by itself, and it's a protected entity. Matter of fact, it's protected greater than an LLC. It's very hard to pierce that veil. Can you sue it? Yes, you can sue an IRA, but you could. It's left to just that entity, just like it's isolated, just like any other LLC or something. They're not going to be sued. So what some people do, like Russell, they might have 20 different IRAs. And then they use each different IRA as just holding different assets, and that's separating out the different lawsuits sometimes easier.
So what you're saying is, from a practical perspective, you haven't found that using the trust or the LLC was an effective mechanism for asset protection purposes.
No. I mean, sometimes you can help cover it up a little bit, but it doesn't. I've never seen where just the IRA would do it. It really comes down to ease of use, and am I getting feed to death because I've gotten so many transactions in my IRA, right? So some of my clients go the other route. Which I almost wish they wouldn't. I wish they would put an LLC in there because they use our Gold Family Plan, which is you pay a pretty big fee once a year, but you get unlimited transactions. And so they just open up. I have one guy that's got 25 different Roth IRAs, and he lets me do all the work. I wish he would get his own LLC.
I wanted to ask you this before we move on.
Sure.
How big should I let an IRA account be before I should go form another IRA account?
You know, I would honestly say that if it's getting into the millions, I would spread it out. I would not keep it all into Quest. probably
Or
somewhere
different
over-
accounts even within Quest.
Or yeah, like a total aggregate. I would have some at Quest and some at Mid Atlantic, so forth and so on. Anything over 2 million, I would say for sure. I used to say 1 million, and I think that makes sense. I have no evidence of it, but I think that too big of a 5498 from one self-directed custodian is an audit magnet.
So if I decided that around $500,000 to $750,000, I would never let one single account get bigger than that, and then I would go form another account. Probably would be a safe strategy.
Yeah.
Right? And if one IRA account is audited and there's a problem with it and they bust it, as the expression used, it doesn't affect the other IRA account.
Not typically. Typically they'll look at just inside the one. Depends on what you're busted for. You know what I mean? Why they're digging. If you're a drug cartel, which I mean honestly, that's one of the reasons it happens. Things like that really do happen. It's the banking world. They'll dig and dig and dig. If you're just a transaction guy and made a transaction, boo-fooed this up, then they'll leave it to that. Yeah.
Okay.
Does that help? Again, you can't be your own managing member of the trust. Should you do your collections yourself? What do you think? I say no. I can make an argument that you could do it.
Well, Nathan, you can save money. Okay, you can save money.
Yeah. Again, I could make a legal argument that you could do this in your IRA by being a good fiduciary, but I think what Eddie's getting to is why would you want to?
Even if you do something, even if you make a call, or even if you get forced place on it, or whatever it is you may do, when you get the check every month, what are you going to do with the check? If you're servicing your own deposit it, no, Kimosabe, we definitely ain't going to deposit it. Because all of a sudden now,
you just gotta forward it to
I'm
Quest.
doing business with myself.
Right.
Right, so that is the biggest issue. If I get the check, now what have I got to go do with the check?
You got to get it to Quest.
I got to go get it to Quest.
Well, they can pay directly into Quest if they want to, blah, blah, blah. We have systems that do it. But the whole point is tracking your payments, knowing what's going on. All of this stuff is a lot of work. It's the same reason why I say everybody in the room should have a maid. And people go, well, I don't have a maid, because I don't make enough money. And I say, no, you don't make enough money because you don't have a maid. All right? Because you're spending all your time cleaning your toilets and you haven't learned to prioritize what's important to you. So, what?
I just think that's funny.
So no, don't do your own servicing, especially with IRAs. You're always trying to not touch the money anyway. But honestly, it's just worth the money you save is peanuts versus the time and the aggravation that you'll have doing that. It'll drive you nuts. Hey, this was a really important topic I want to talk about. And it's getting to be rougher and rougher and rougher. The Banking Commission is putting pressure on self-directed companies, right? Because some of the big banks don't like us. They don't like all the freedoms we offer. Can you imagine that? It's the truth. So one of the big ways that they're doing it is, hey, they have to give a value of what's owned inside that IRA. Thank God. Today's my 1-year anniversary of being a Texas trust company. Texas is a tough regulation department, but they have a big sign on their wall, and I honestly believe that it says tough but fair. I was restored my faith in government, and as Texans, for those of us that are Texans in the room, you should be very proud because they really do a very good job of keeping our economy robust by controlling the banks very well.
So you went from essentially having to deal with a bank really being the custodian for the money that you are now a custodian.
I'm a
you are
custodian.
a trust.
We are a trust company.
Today
1
is
year
your
today.
1 year anniversary?
1 year.
Well, I think that deserves something.
So I will also tell you that in that last year, we funded $569 million in notes. Thank you guys. Thank you, Note School, because a lot of that came from you guys, if you want to know. But here's where the pressure is. We got to give a value of this, right? And they're really getting sticklers on it. So we kind of got them pinned down at this point, and they've worked with us to come up with some solutions. Basically, they said that you have to every year tell us what it's worth and give us some documentation. And I was like, well, what documentation do you need? They're like, you decide. So
it could be like an investment amortization.
Correct.
Right? You could take your investment price and your yield and the payment, and so long as the customer's paying as agreed, you could just probably kind of slide down the scale and show that as a balance at the end of the year.
Yeah, you can simply make a statement. I bought this at a discounted note. It was 30%, right? The principal's been paid down 3% over this year. And because it's performing about the same way, I feel that it's still worth 30%. That would be fine for documentation. If it's a note that you originated, so the value is the face value, then the face value of the note would make it for the origination. Honestly, we can get through it 90% of the time once a year, no matter how many assets you have in a 5 or 6 minute phone call. We even have a little app to do on the phone. So we figured out how to streamline that process so that we can get the fair market values out once a year. There is an exception. If we're taking an asset and we're transforming it from a traditional IRA to a Roth, in other words, we're going to pay tax on that. We have to have that truly what we call a hard value at that time. All right? So you're going to have to call Eddie and say, hey, I need a note appraiser to appraise that note. Now, once again, if it's the principal balance of the note, in other words, the whole value, we don't have to worry about it. But when we start dealing with discounts, you're going to, because at that point, that's a taxable event, and they want to see a hard value. So we got them to bite into the fact that the time we only really need a hard value is if it's a taxable event like a Roth conversion.
Got it.
So the rest of the time we can get it handled pretty easy. Any questions about that or anything? All right, move on. Can you really buy a partial note for $100 in my Roth IRA? Can you do it? Can you?
I don't know that the audience even knows how that started, right? So understand all through the 80s and all through the 90s, we were buying a cash flow of a note, less than the whole amount of the note, a partial, and then we would sell that same partial, or we'd sell less than the cash flow than we bought, or we'd buy the whole note and we'd sell part of the note, a partial. We'd done it literally over 20,000 times.
Right.
So this is a very comfortable thing. So I'm in New Orleans teaching a class with Quincy Long, his brother, and Walter Wofford. This is around 2002. I didn't write down the day, but it's about right. And so Quincy is like the smartest guy you guys have ever seen. I mean, he is insanely smart. He can answer 10,000 IRA questions off the top of his head. It's just amazing. And everybody knows it that's been around. And so it was one of these sessions where we're having a Q&A and people are just blowing him up with questions that nobody's going to remember the answer to next Thursday afternoon. Right? Which I hate that stuff because I'm dumb and I don't even know what they said. And then finally I'm like, I pull Walter aside and I'm like, Walter, listen, this is really cool, but the problem is they're going to leave here and the value of the information really isn't going to be meaningful, right? That's what we're trying to do here today is give you meaningful stuff, right? Quincy's so smart, he can answer anybody's complex question, but the guy sitting next to him doesn't even know doesn't have the context to get the answer. I said, why don't I'm just showing him some kind of model and just show him how to make money. So I'd done all these partials, I had that graph that you've seen me use a zillion times. And this is way forward. I were on the very front side to being in the training business, right? And so I pulled that graph up and I said, Quincy, if I bought a note, a $100,000 note at 8% interest for 20 years, and I bought that note for $70,000, I said, and I could negotiate a price, I said, how much money does the IRS consider to be an investment? Now, if you know Quincy well, Quincy's never going to give you a direct answer.
He's an attorney.
That's not possible. He's a lawyer, okay, and he's an IRA guy, all right? So he says, well, there's no specific rule, blah, 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 blah. I said, okay, Quincy, just throw a number at me. Well, generally speaking, it's considered about $100. And that's where it started.
So can you do it? Can you take a $100 Roth IRA, buy a partial, use someone else's money to fill it in and make a whole bunch of money in your Roth IRA? The answer is yes, but there's some things that you should know if you're going to do it, or you should think about it, all right? First of all, if I'm going to do that in my IRAs, I'm going to do it in an IRA with other assets in there. Other performing notes, non-performing notes, and some stuff in there. And if anyone ever comes and asks, I say, oh yeah, I bought that and I was thinking about keeping her, but someone came along and I was able to sell it. And so being a good fiduciary to my IRA, I perform my duties. Thank you very much. Right? Everyone follow that? So that would be okay. I could do this. Let's say I'm 19 years old and I only got $100.
Like little Colt we had up here
Yeah,
today.
like a little Colt, right? Okay. What am I putting at risk, guys? You see what I'm saying? If I get caught, I'll have to pay tax on it. If I do it, if I don't, there's a 95% chance I won't have any problem in this little IRA anyway, and there's not a lot of things to put at risk. You see, this may not be my brother's answer. This is me, Nathan, the investor. That's a different answer. You get what I'm saying? I would risk $100 if
Exactly.
It's like my wife, who's an attorney, and people talk to her about asset protection all the time. And she says, well, first you got to make sure you have some assets to protect. Mm-hmm. Let's get to that. A lot of people get all worried about that before they have anything to worry about it with. But
And the other thing, two or three things I want to make sure that you guys get out of this. And listen, whatever you give us credit for, like taking this to the industry, these guys have taught us this side of it, and we're not ever rendering legal or accounting advice, but we've taught well enough. We think we know the questions that you should be asking. And one thing I've always heard you say is, Martha, don't ever use a round number.
Yeah.
Right. So instead of using $100, that's not the right number to pick. So pick a kind of a different number, and don't ever get hung up on the $100. So if you've ever seen the $100 strategy, and that sounds like really that's a cool thing, what he's saying is don't go out and do that 18 times in one account in a year.
That's what I was going to get to. What you shouldn't do is repeat and rinse and repeat and rinse and repeat and rinse in that same account. There's two different ways that they can come after you. They could treat it like you're running a business, go after the unrelated business income tax. I could say that you're possibly performing service. You open the door enough. Does that make sense? You open the door enough, and you got to understand something about the IRS. They do not have like the greatest tax attorneys in the world. They do not look for the most complicated deals. They look for the biggest door to walk through. Does that make sense? I'm being serious. They do. Like they want the low fruit.
There's three of them sitting right out
Yeah,
there.
I know, but they know. Oh, they know. Anyway, oh God, you threw me off now. Guys, you can use your knowledge in this to pick up people. All day long, I have clients that are looking to buy the type of deals that you could do right now by using other people's IRAs. Whenever I shut my door, I do talk all the time about not leaving money with a self-directed custodian because it doesn't earn interest. When I shut the door, right, yesterday, there was $402 million sitting in cash at Quest. Now, there should always be some in transfer, but that's about 80% high. Why do you think that money's there? Honestly, they've done enough of it that they know it works, and it's like, I don't want to mess with moving it back and forth. I'm out looking for a deal. You get where I'm going with it?
And it's a market condition, guys. We're in a yield-starved, deal-starved market, right?
Also, people are having a hard time finding people. I know I used to do a lot of loans to flippers. That's tough right now. I see a lot of loans, but none I would fund.
Exactly.
Create your own private source. Typically, once you develop a relationship with someone and they loan you some money, they'll continue to loan you again and again. And especially if you can bring in the IRA portion of it, and like I said, make it a family thing as you learn how to do that. And relationship build. It's really good if it's husband and wife working together in this, because sometimes you guys have different skills. One's good at finding the deals and one's good at making relationships. And that's really good when you're working with other people's money and creating those type of things, right? There's trillions of dollars in retirement accounts. tons of money available to do all the things that we're taking the time to learn this weekend. It's available out there. For those of you that are here in Dallas, we have an education center right down the street. We have classes all the time. My clients come in all the time, and they're really looking for you guys. Just show up and do some stuff. Eddie comes out and teaches out there sometimes for us. Spread knowledge and then help use their money. So kind of for today's speech, it's remember that you use other people's IRAs to fund your transactions for today. And then, after doing a Roth conversion, I do that for you guys. I don't make any money off of Roth conversions. They're free at Quest, okay? But, learn how to do that. Learn how to convert some money over and have some Roth IRA money. Everybody should have a Roth IRA. It is a fundamental wealth building tool in today's world. Here's some stuff you might not know about us at Quest. We haven't changed our fees in over 9 years. We are an employee-ran company. Though me and Quincy love to tell you how smart and good looking we are, Quest isn't what it is because of us. We're an open book company, and we have been since the day of our inception. Because me and Quincy never thought Quest would make any money at all. We actually just did it to have fun. We were learning about investing and meeting great people like Eddie and making money with our investments. That was always our thing. So over the years and years that we've had Quest, 97% of everything that we've made at Quest has gone back into Quest. That's a true statement. And so when you pick up the phone and you talk to an employee and they go, hey, how can I help you? How do I want to make your day? They really are invested. They're invested in you being happy with the experience. And you'll see that in every day that we do. Also, because of that and because of the support from you guys, we've been able to roll back into the community. We've opened the education center here in Dallas. We started with the one in Houston. And they're big, nice classrooms. It's big enough that you can fit 100 people in there with sound and equipment and everything. Different real estate groups and stuff come out and use the you pay a little cleaning fee, I don't know, $25 or something, and you can use the room, something like that. There. And now we have one in Austin as well. Soon we hope to open East and West Coast. So some little things. Also, we do a lot of political stuff with the Seller Finance Coalition, where you hit us with a check every year, and those type of things. So some things that you don't know about Quest is that we are very family ran. What I would highly recommend you do is Quest is like a tool, and you should have a tool in your pocket all the time, which is an IRA specialist. Martha knows. She calls me. She tortures me sometimes. That's how she knew I was talking about you, right? Right? But you should have your own IRA specialist. I have over 15 of them on staff. They're very strong, they're highly trained, and they know what they're doing. And you should do a tune-up all the time. About once to twice a year, you should meet with your IRA specialist, talk about your family stuff, what's going on, life changes, and you'd be surprised at the knowledge they have. Most of the time that you're talking about those type of things, you're talking to somebody that has vested interests in the game. They're trying to sell you a stock or trying to sell you insurance. At Quest, they're a completely neutral party. They have no commission basis or nothing that is going to go on with that conversation. Does that make sense? It doesn't matter to them what decisions you make. They're free of giving you that information for free. And here it is. Consultations or Quest are absolutely free, whether you're a client or not, whether you have an IRA with us, you have a 401k with us, or you have a 401k or an IRA with someone else. Honestly, we will win your business and we will answer your questions honestly. Sometimes it doesn't even make sense. I have people say, I want to move to your company. I'm like, you're going to get hit with too many closing fees and stuff. Let's wait for these assets to do. We'll be honest with you. I swear we will. Sign up, and I'm not trying to sell you anything other than go downstairs and just put your name down and you have a telephone call with an IRA specialist. It will be life-changing. How was that for a close? Oh, we put some applications on there.
How about this? We decided, Nathan and I talked about this, and we said, this is typically a boring subject, and it's typically a subject that you hear the generic stuff over and over and over that I think everybody in this room's already heard. And Nathan comes to some events that we do, and I said, Nathan, let's do that deep dive stuff. Let's do the like how it really works and where you really see issues and the things it really know. So I thought he did really just a phenomenal job of really cracking it open to say, and this is where the rubber meets the road in this business. You guys give him a hand.
Thank you, guys. Eddie, love you, buddy.